Hi there everyone. There have been a few interesting things that have happened over the past week or so that I wanted to talk about quickly. Some of them are quite relevant to the portfolio and also my investing style. Let's take a look. The first is that there's been a new memo from Howard Marks. Howard Marks, the investor, not Howard Marks, the infamous Welsh drug smuggler, just in case you were likely to get the two confused. Howard Marks is a very famous investor. His memos are quite popular. Warren Buffett is an avid reader of Howard Marks's memos and his books. Just to provide a little bit of context, so he is the co-founder of Oaktree Capital Management. It's the largest investor in distressed securities worldwide. He has been in the investment game for many, many decades. Has he been a successful investor? Well, he is one of the wealthiest people within the US, number 391 on the Forbes 400 rankings of the wealthiest Americans. I really enjoy reading his memos. There's usually at least 4 that he publishes every year, although some years he publishes only 1, and sometimes he publishes a lot more than that, like he has this year. The reason I wanted to talk about his most recent memo is it ties a few different themes together from this year. The one that I think is most important is in the title of his last memo, What Really Matters. Now, I highly encourage you to go to the Oaktree Capital Management website and subscribe so that you get notifications every time there is a new newsletter, but I'm going to summarize this one for you. He starts by going into what doesn't really matter. So his style of investment is somewhat similar to Warren Buffett and others of that ilk. Now, I know that I talk about macroeconomics quite a lot, and that's because I have a natural inclination to understand that type of thing. It also means that I understand why equities are broadly skyrocketing or falling off a cliff, but I tend to agree with the sentiment of Howard Marks. So his opinion is that macroeconomics and also other short-term events shouldn't be used to try to predict the future just because you can't account for every possible thing that is involved in the macroeconomic picture. You couldn't predict that the Ukraine war was about to start. You would never have been able to predict how high the price of natural gas was going to be. And these are just 2 things in a landscape of thousands, probably tens of thousands of influences. He's also of the opinion that people shouldn't be traders. They should be more of a business owner mindset. We should view ourselves as partners in the businesses that we invest in, align our interests with those people, instead of trying to trade in and out of equities, instead of trying to speculate on the change in price levels for a particular equity in the short term. Other things he says don't really matter are the short-term performance, the volatility within your investments, and you shouldn't be hyperactive. You shouldn't be buying and selling things a lot. The single thing that he says does matter is the performance of your holdings over the next 5 to 10 years, and that you should be focusing on microeconomics. Focus on the details of a particular business. It's easier to understand a business than it is an entire economy. And he admits that you won't always get a winner, even when you do focus on microeconomics. If you do the hard graft, once in a while, there's going to be a flop. But you do increase your odds of success significantly by focusing on specific businesses, the people, the products, the strategy, the competitors, etc. If you really want to get the most out of his most recent newsletter, I recommend that you read the one before this too, which talks about his perspective on trying to forecast using macroeconomics and what he's seen through the decades of people trying to forecast based on macroeconomics. The long and short of that is there are very few people in the world that have had a long-term successful career doing that. And because there have been so few, it's almost as though those few prove the rule that it doesn't really work in the long term for the bulk of investors. The second thing that I wanted to talk about is Bob replacing Bob in Walt Disney. I'm not sure how many of you follow the news with regards to Walt Disney, but Walt Disney had a long-term CEO called Bob Iger. He was very successful in that role. He held that position for, I think, a couple of decades. Then around the year 2020, he was looking to retire. He'd reached retirement age and elevated Bob Chapek from his position. He was also fairly senior within Walt Disney to the position of CEO of the business, taking over from him. We're now 2 years and some change down the road from that swap over, and it seems that there's been a revolt inside of Disney, and Bob Chapek has been ousted and Bob Iger is back in. Now, I'm sure that Bob Iger will do fantastic things with the company. He has a very good track record of running the company, but what I'm less sure of is if Bob Chapek was problematic in his role as CEO. I think the thing that executives and investors were most unhappy about was the decline in Disney's share price. Now, does the bulk of the fault for this, or does any of the fault for this, fall on Bob Chapek's shoulders? I think that's a lot harder to say. First of all, the share price of many different equities around the world has dropped significantly through the past year, as we all know. Secondly, there's something called the fundamental attribution error. And this is an error in the way that humans are wired to think. We have a tendency to blame people for particular outcomes, when instead we probably should be blaming the circumstances that those people are in for those outcomes. If we look at the circumstances under which Bob Chapek took the helm at Disney, we see that, first of all, there was this enormous acquisition of 21st Century Fox in 2019, $71 billion, and I think somewhere around $18 billion of debt 21st Century Fox was inherited by Disney. You can see there's a jump up from 2018 to 2019, $16 billion in debt to $41.5 billion in debt. The process of merging two behemoths is an enormous undertaking that almost always is quite rocky, because you've got two companies that are quite different, not necessarily in just what they do, but also in the styles and cultures of those businesses. So it takes time, and it's usually quite expensive to do, and more often than not, it's unsuccessful. And of course, we also know that 2020 brought with it coronavirus and the lockdowns that really hammered the revenue of companies like Walt Disney, particularly because it has brick and mortar retail stores, it has those theme parks that people just couldn't visit. And so the revenue of Walt Disney took quite a hit on the back of these challenges. Profitability also took quite a big hit. And this is where I think investors are unhappy. So the share price has been dropping, and obviously most of the market has also been dropping, and Disney has dropped along with it. But it's more these operating margins, this net profit challenges that investors are unhappy about. Another thing that has impacted the company heavily has been the investment in direct-to-consumer channels such as Disney Plus, which has been very successful in acquiring subscribers, but has been very expensive to invest in order to create the production capabilities and technology for them to run on. Long story short, was it the right move kicking Bob Chapek to the curb and bringing in Bob Iger once again? I'm not so sure. I don't think it's very easy to say. Will Disney ultimately be successful because they brought Bob Iger back? Well, I think that the company was going to be successful under Bob Chapek. It feels as though the worst is behind the company. Revenues are increasing, and I'm sure that this behemoth will get margins back to where they were once upon a time. It's just that it takes some time to get there. The next topic I wanted to touch upon is Prosus. This is a very strange company. It has its roots in South Africa. It was spun out of a South African business called Naspers that made a very early investment in Tencent and made a killing off of the back of that investment. Prosus is a company very much like SoftBank. You can think of them as a combination of a venture capital company as well as an investment fund. One of the things that I like most about this company and that I find most interesting is the fact that they own this swath of companies. Either they own the businesses entirely, or they own large chunks of those companies. And the net asset value per share, so the total value of the things that they own divided by the number of shares that they have within the company, is 93 euros NAV per share, but the share price is only 58 euros. So they trade at an enormous discount to the value of the things that they own. Now, this isn't completely unusual for this type of business, but the discount here is enormous. Now, there are some key reasons why they trade at such a discount to the net asset value. The first is that they have a number of Chinese investments, and the Chinese market is obviously going through its own financial crisis at the moment, and there are other political challenges. The second is that in spinning the company out of Naspers, there's quite a murky corporate structure, but they are looking at simplifying that as time goes on. The company also has been repurchasing its own shares, and this is an open-ended share repurchase program, which they intend to go on for a number of years. They've sold some assets that have been very profitable for them, and now are buying back their own shares. Every time they do this, they reduce the number of shares in circulation, which means that the net asset value per share increases because the number of shares are dropping and the total value of things that they own stays the same. So in my opinion, there are many tailwinds for this business. In terms of the earnings report that was released, the numbers were so-so, small amounts of growth in some areas, big growth in other areas. The challenge right now is that given where we are economically, so growth is slowing just about everywhere economically, the areas that they work with tend to slow down when economic growth slows down. When that turns again, I think that they will see explosive growth. That is just the cherry on top though. Because of the discount of the share price to their NAV and the share repurchase program, I think that they're a good investment even if they didn't see explosive growth in the assets that they own already. And the final thing that I wanted to talk about, once again, earnings. Earnings for Alibaba were posted last week. They had a fairly chunky miss on revenue. They beat on EPS, and the stock price absolutely surged on the day. It's always a little confusing when this happens, and there are always a number of theories about why it did happen. But the fact of the matter is that Alibaba is not dying. It is a company that has been holding more or less steady and looks as though it's beginning to grow again. This is despite the numerous challenges that it's experienced over the past 2 or 3 years. They were absolutely battered by the new regulation that kept on coming out of Beijing. They were hit by an enormous fine. The IPO of a subsidiary, a very successful subsidiary of theirs, was completely put on pause, and that company has been forced to restructure. And despite all these challenges, the company's revenues have continued to grow. The orange line you see on screen is the revenue that Alibaba has brought in. Now, they've had to deploy profit into the company in order to make the company compliant with new regulations, some of which included things like massively increasing wages for some of their employees. A fantastic thing to do, but obviously a very costly thing to do too. Nevertheless, even though they've had to take profits and reinvest it into the operations of the business, you can see the green line below has been relatively steady. That's their profitability, the EBITDA. Now, all the while that this has been going on, China's been working its way through its financial crisis, which one day it will get over. It's just that zero COVID policy that they need to deal with. And all this time, the EV over EBITDA for Alibaba, a measure of the expensiveness of the company, has been dropping. That's the blue line that you see on screen. And this is not the only measure by which Alibaba has become cheaper and cheaper over time. There'll be lots of people that talk about the delisting risk that Chinese companies that are listed in the US are facing, but the US auditors are in China and have been there for some time, and progress has been pretty good. It's been quite a painful experience to be invested in companies like Alibaba, but slowly and surely the risks are melting away. The company is incredibly cheap. All right, that's it for today. Just wanted to give a short, sharp update on some things that are relevant to my portfolio. I hope you enjoyed it. Have a good weekend. Speak to you soon. Goodbye.